Central Bank. In this module, you will understand the need and importance of central bank, explain the functions of central bank, and identify the instruments used by the central bank to control credit in the economy. When we aim to build a strong banking system and economy, we need a good structure. Central Bank of a country functions to achieve these goals. Reserve Bank of India is India's central banking system. India was facing serious economic troubles after the post-World War. The Reserve Bank of India was conceptualized on the basis of the guidelines presented by Dr. Ambedkar that were eventually passed as the RBI Act 1934. The Reserve Bank of India was founded on 1st April 1935 to help the economy run smoothly. Functions of Central Bank. Issuing of notes. The Central Bank of a country is the sole note issue authority. In India, RBI as the central bank of the country issues the notes of all denominations except 1 rupee note, which is issued by the Ministry of Finance, Government of India. The coins are issued for circulation only through the Reserve Bank in terms of the RBI Act. Banker to the government. The central bank acts as a banker, financial advisor and agent to the central and the state governments. As a banker to the government, it makes transactions on the behalf of the government. As a financial advisor to the government, it advises the government on important issues of economic policy. As an agent, it undertakes buying and selling of securities on behalf of the government. Lender of the last resort. During crisis, if commercial banks fail to meet the obligations of their depositors, the central bank plays a crucial role. The central bank stands by the commercial banks as a guarantor and advances necessary credit to the commercial banks against securities to ensure the solvency of the latter. This saves the commercial banks from possible breakdown. Bankers Bank. Central bank acts as a banker to all other banks in the country just as commercial bank acts as a banker to general public. Custodian of Foreign Exchange Reserve. The central bank acts as a custodian of the foreign exchange reserves of the country. Controller of Credit. The central bank has got various instruments to keep the economy growing at a steady pace. These include bank rate, open market operation, cash reserve ratio, statutory liquidity ratio, margin requirement and credit rationing. Bank rate is the minimum rate at which the central bank discounts the first-class bills of exchange and provides credit to the commercial banks. Open market operation is the policy of the Central Monetary Authority to sell and buy the government securities in the market to decrease or increase the stock of high-powered money in the economy. Cash reserve ratio is the minimum fraction of the total deposits with the commercial banks, which they are required to keep with the central bank. Statutory liquidity ratio is the minimum fraction of the total deposits with the commercial bank, which they are required to maintain in the form of specified liquid assets. Margin requirement of loan is the minimum security price charged by the commercial bank for granting loans. Credit rationing implies controlling the quantity in the form of loan. Here, amount of loan is determined for speculative purpose. Now let's recap. Central bank is the apex institution of a country's monetary system. Reserve Bank of India or RBI is the Central Bank of India. Functions of central bank. Issuing of notes. Banker to the government. Lender of the last resort. Bankers Bank. Custodian of Foreign Exchange Reserve. Controller of Credit. Instruments of credit control are bank rate, open market operations, cash reserve ratio, statutory liquidity ratio, margin requirement and credit rationing.